What if I told you that the biggest financial decision you make every month doesn't happen when you buy a car, sign a mortgage, or invest in the stock market? It happens just a few minutes after your paycheck lands in your bank account. Most people unknowingly make one small decision that keeps them living paycheck to paycheck for decades, while others quietly build wealth without earning extraordinary salaries. In today's video on Jimmy Invest, you'll discover the simple habit financially successful people follow every payday, why your brain naturally works against it, and how one small change can completely reshape your financial future. Imagine it's Friday afternoon. Your salary finally arrives after 2 weeks or an entire month of work. You glance at your banking app and see $4,900 deposited into your account after taxes. For a brief moment, everything feels fine. The number looks reassuring. You feel a small sense of relief because your account balance is higher than it was yesterday. But before the weekend even begins, something quietly starts happening. Your rent of $1,700 leaves the account automatically. A $420 car payment follows. Student loan payments withdraw another $280. Utilities, internet, insurance, and your phone bill take another $500. Your credit card payment removes $350. Then groceries, fuel, coffee, a streaming subscription you forgot you even had, and a dinner out with friends slowly chip away at what's left. None of these purchases feel irresponsible on their own. They're normal. In fact, they represent the lifestyle of millions of middle-income Americans and Europeans who work hard every single day. Yet by the middle of the month, your account balance somehow looks almost exactly like it did before payday. You wonder where all the money went. The strange part is that your salary wasn't small. The problem wasn't that you earned too little. The problem was that your paycheck had already been assigned to everyone else before you ever thought about yourself. Banks, landlords, lenders, utility companies, insurance providers, and retailers all received their share first. Whatever remained became your savings if anything remained at all. Most people never question this system because it feels completely normal. Since childhood, we've been taught that bills come first and saving comes afterward. Unfortunately, afterward rarely arrives. Savings become whatever survives after spending, and for many households, nothing survives. This creates the illusion that saving is difficult when the real issue is that saving has been placed last in line. Imagine walking into a grocery store after hundreds of customers have already emptied the shelves. You wouldn't expect to find the best products still available. Yet that's exactly how many people treat their finances every payday. They allow every expense to take what it wants and then hope enough money is left for their future. Hope, however, is not a financial strategy. This single habit explains why two people earning nearly identical incomes can end up living completely different financial lives. Consider two co-workers earning the same $75,000 annual salary. Both receive similar raises, live in the same city, and pay similar taxes. The first person waits until the end of the month to save whatever is left. Some months that's $50. Some months it's nothing at all. Unexpected expenses always seem to appear at exactly the wrong time. A medical bill, a birthday gift, car maintenance, or a weekend trip quietly wipes out any remaining cash. The second co-worker does something that seems almost too simple to matter. The moment the paycheck arrives, before paying any optional expenses, they automatically transfer 15% into investments and emergency savings. The remaining money becomes the amount available for everything else. At first glance, both lifestyles appear similar. Neither person is driving luxury cars or taking extravagant vacations. But something invisible begins happening beneath the surface. Every month, one person slowly builds ownership while the other continuously finances consumption. The difference isn't income, it's sequence. Financially intelligent people understand that the order in which money leaves your account is often more important than the amount entering it. This concept is known as paying yourself first. Ironically, it isn't really about paying yourself. It's about making your future self impossible to ignore. Human psychology naturally prioritizes immediate comfort over distant rewards. Behavioral economists call this present bias. Our brains consistently overvalue today's pleasures while underestimating tomorrow's needs. That's why buying a $90 pair of shoes feels rewarding instantly, while investing that same $90 feels almost invisible. The future doesn't send thank you notes. It doesn't provide immediate excitement. As a result, your brain quietly convinces you that you'll save next month instead. Then, next month becomes next year. This isn't because people are lazy or financially irresponsible. It's simply how human decision-making evolved. Thousands of years ago, prioritizing immediate resources helped people survive. Today, that same instinct quietly works against long-term wealth. The financial system understands this psychology remarkably well. Companies don't compete for your savings, they compete for your attention before your savings ever exist. Every advertisement, subscription service, limited time offer, financing plan, and one-click checkout is designed to encourage spending before thinking. Even salary increases often fail to solve the problem. Someone receives a $700 monthly raise and promises themselves they'll finally start investing. Within months, they move into a nicer apartment, upgrade their phone, lease a newer SUV, dine out more frequently, and gradually increase monthly expenses until the raise disappears completely. They genuinely believe they're improving their lifestyle, yet financially, nothing meaningful changes. This is lifestyle inflation, and it quietly traps millions of households regardless of income. Wealth doesn't usually disappear through one catastrophic purchase. It disappears through hundreds of small decisions that individually feel harmless. That's why financial progress rarely depends on making one brilliant investment. More often, it depends on protecting your paycheck during the first few minutes after it arrives. Those first few minutes determine whether your income becomes wealth or simply becomes someone else's revenue. The most valuable financial advice isn't complicated. It doesn't require perfect timing, extraordinary discipline, or a massive income. It simply requires changing the order in which your money moves. When you get paid, make sure your future gets paid first. Over months and years, that one habit can quietly transform your financial life in ways that earning a bigger paycheck alone never will. If you enjoyed this video and want more calm, practical insights on building long-term wealth, consider subscribing to Jimmy Invest.